In this video, guys, I'm going to look at, do market makers trade against you? Stay tuned. Hey guys, a warm welcome to you. Okay, so do market makers trade against you? To me, there's two kind of questions here, or two ways of looking at this. One is that we're looking at it in perspective of currency traders, and does your currency broker trade against you? And the other question is, do market makers in stocks trade against you? So let's look at and address them both. So market makers in terms of a currency broker, you've got two options here. Either you're like a trade-through broker where he's literally just providing you a service and he's passing that risk on to someone else and taking a fee from the middle. That's some companies, they will kind of give you a direct market access, so to speak, and they will add a commission onto that, and that's how they make their money. They make their money from the commission they're paying, or they'll kind of mark up the spread slightly. Anyway, they're adding, as a middleman, giving you facility to access that liquidity, they're charging you a fee, and that's kind of a straight through. So the other one is a market maker, and a market maker is somebody who technically offers you a price and you take the trade against him. He's the counterparty, he or she is the counterparty to your trade. Now, if you look at it in terms of a currency broker, say they're a market maker, their perfect scenario is that they have a group of buyers, a group of sellers for an instrument, or if you can triangulate it around over 3 instruments, and they're net neutral, but they're taking the spread in the middle. So some guy comes along and buys 100 lots here of Euro GBP. Someone comes along here, sells 100 lots of Euro GBP. There's a bid offer spread. The market maker basically takes the spread in the middle. That's the perfect scenario. Of course, it doesn't always work like that. But the theory is, and the question that we're asking is, do market makers trade against you? Well, ultimately, they are giving you a two-way price, and because of that, they're taking on some risk, and because of that, they need to be compensated for it, right? They're in business, they need to make money. So they should be compensated for taking on that risk. Now, if we look at it in terms of a currency market, they can't ultimately dictate the price of the currency. So in a different scenario here to the stock, and we'll look at the stock in a second, but in a currency market, let's say they're taking on a lot of buying orders. A lot of buying orders are coming through. They are now net short heavily. What do? Now, what they can either do is they can either hedge that risk into the market themselves by going out and buying some in the market, or they can aggregate it with their book and they can say, okay, well, actually, we're neutral on this amount. We can take on some of the risk, or they take on some of that risk themselves. Now, in the stock example, they can really adjust the price that they offer. Now, if we're looking purely at a market maker driven stock, like some of the ones on the London Stock Exchange, the CQ stocks, purely market maker driven, they are literally taking on risk. And what they will then do is they will adjust the stock price bid and offer based on supply and demand. So if they're very, very heavily long, it will try and encourage some sellers in. So if they're aggressively long, they might do all sorts of things, and there's kind of things they do with that. They kind of adjust the price, they'll widen the spread, they'll narrow the spread to make sure they try and get the next deal. They want to try and offset that risk. Ultimately, guys, they don't really want to have excessive risk because they're not in the business of taking excessive risk. If they were in the business of taking excessive risk, FX broker or stock market maker, FX market maker, sorry, or stock market maker, they would just be traders, because that is what we do. We just take on full risk, right? They want to be compensated for taking them in the middle. Now, it's not to say they don't take on some risk. Of course, they're forced to, and sometimes they're forced to take on some risk, and they can't do anything about it. Specifically for that stock model, where a market maker may well be aggressively long, everyone's been selling to him, but of course, it's going to lower and lower and lower his price because he doesn't want to get long anymore, and then the market makers will follow, and that's why prices kind of collapse. He'll then try and bring his offer down, so he kind of neutralizes it a little bit. Maybe he'll take a bit of a hit on it, but ultimately, during the normal times, he's making a margin between the two. The FX broker, on the other hand, can't adjust the price of Euro GBP. That's just supply demand multiplied by all the banks and all the participants out there, right? So all they can do is either ride the risk or offset the risk. Normally, they will have a kind of an area or zone where they're happy to take on some risk, and outside of that, they'll hedge. So yes, technically, they're trading against you, but in the FX market, they can't do anything with that. They can't. It doesn't give them an advantage of anything, unlike the stock market environment, where if we're looking at a price that's ultimately just dictated by market makers or predominantly dictated by market makers, they can then adjust the price that they're offering to suit. You can adjust the price you're offering all you like in the currency market. No one cares because you're just a nobody. So there's no real disadvantage to trading with them. Now, of course, there may be games that go on if you're buying from a market maker in the currency market that they then kind of try to reduce the size you can buy at. Maybe they widen the spread under certain hours, but we're not talking about that. It's kind of small anomalies. Generally speaking, the question is, does a market maker trade against you? And the answer is yes, technically they do, but it's nothing to fear really in the currency market. Now, when we talk about them on a global scale, as in, hey, they really are taking the aggregate of everybody, then they have got actually an incentive to lose, and that's a different video. When they're talking about if they're taking the opposite view of the majority of traders, then they're ultimately incentivized to lose, which is why it pays to go with a broker that isn't incentivized for you to lose. But on a one-to-one basis, there's no real kind of downfall with doing that, trading against the market maker. But if you're trading in a stock, the market maker is ultimately trading against you and they want to make a margin, you should be paying them. They need to really be making money from each trade, so expect to kind of lose a little bit on it. That's what the spread's all about. Sometimes you'll lose a lot because the spread is widened. Sometimes you'll be stuck in a trade that's being moved by market makers or untradeable because the spread's gone wide because they're trying to track buyers or trying to track sellers, and that's just the game you've got to play. That's why it's more of a long-term game if you're playing stocks against in the stocks that are governed by market makers. Anyway guys, that is the question. Does a market maker trade against you? See you next one. Take care. Bye bye.